Most traders lose not because they lack intelligence, but because they violate the one rule that governs all market success: discipline in the face of uncertainty. Wyckoff once observed that the market is a mirror reflecting your inner self. If your emotions are scattered, your results will be too. The majority, the 90% who fail, chase prices, ignore structure, and abandon their plans the moment pressure rises. But the true operator, the one who endures, follows Wyckoff's has-shown rule with almost religious precision. He never acts until the market itself confirms his judgment. Take this example. Imagine two traders watching the same accumulation phase unfold. One jumps in early, seduced by the hope of catching the move before others. The other waits for the test, the quiet, almost invisible moment when demand silently proves its strength. When the markup begins, one is trapped in noise. The other rides the tide of cause and effect. That difference, patience over impulse, confirmation over prediction, is the very rule that separates professionals from the public. Wyckoff understood. Consistency is not born from constant action, but from consistent obedience to market law. Those who fail this test do so not because the market defeated them, but because they refuse to master themselves. Ladies and gentlemen, traders and students of the market, tonight, we explore a principle so deceptively simple, yet so universally ignored, that it defines the dividing line between success and failure in speculation. Richard D. Wyckoff, one of the greatest market minds in history, called it the operator's first law of consistency. It is the has-shown rule. He followed with unwavering discipline the very test that 90% of traders fail without ever realizing it. Every trader begins with dreams of profit, but few build the inner structure required to sustain it. Most are lured by price, emotion, and noise, reacting to every tick as though the market owes them an explanation. But the professional, the true student of Wyckoff, moves with purpose. He waits, observes, and acts only when the market confirms what logic and structure have already revealed. Tonight, we will uncover why this rule is not just a trading technique, it is a mirror of one's inner mastery. Because, as Wyckoff taught, the market is not your opponent, it is your reflection. And until you learn to pass this one test, consistency will forever remain out of reach. In the world of speculation, trading discipline is not merely a virtue, it is the foundation upon which every successful operation stands. Richard D. Wyckoff often emphasized that the market is not defeated by intelligence, strategy, or even capital. It is conquered through discipline. Without it, every method collapses under the weight of emotional impulse. Discipline, to Wyckoff, was the silent law that separates the operator from the gambler. A disciplined trader is not one who never loses. Rather, he is one who never deviates from his principles, even when losses occur. Wyckoff taught that the market's movements are reflections of human behavior, waves of greed, fear, and impatience. And unless a trader learns to rise above those same emotions within himself, he will forever be part of the crowd, reacting instead of anticipating. The disciplined operator, on the other hand, operates from structure, not sentiment. He recognizes that each phase of the market accumulation, markup, distribution, and markdown follows a natural law of cause and effect. His decisions are based on observation and confirmation, not prediction or excitement. Trading discipline begins before the first order is ever placed. It starts with preparation, studying market structure, defining clear entry and exit criteria, and determining acceptable risk. Once the plan is established, the trader's greatest challenge is not the market's unpredictability, but his own inconsistency. Every successful trader has faced that internal battle, the urge to chase, to revenge trade, to abandon logic when price moves against him. Wyckoff's wisdom lies in the understanding that discipline is the art of doing nothing until the right moment arrives. It is restraint, disguised as power. Consider the difference between two traders observing a potential breakout. One, eager and emotional, enters prematurely, convinced that his intuition is enough. The other, guided by Wyckoff's principle, waits for the test, the moment when the market reveals whether true demand supports the move. The first trader's discipline falters, and with it, his capital. The second acts with precision, and when the market confirms his judgment, he participates in harmony with the larger forces at play. That small difference in behavior, waiting for proof instead of guessing, is what defines trading discipline. Wyckoff often referred to the disciplined trader as an operator, someone who treats trading as a business, not a bet. Every move is calculated, every loss accepted as part of a larger plan, and every gain reinforced by process, not emotion. To achieve trading consistency, discipline must evolve from an effort into a habit. It must become second nature, the invisible framework that guides every action. In essence, trading discipline is the quiet strength behind every profitable trader. It is the unwavering commitment to one's method, even when doubt whispers and volatility tempts. Wyckoff's legacy reminds us that the market rewards not those who act the fastest, but those who act the wisest. And wisdom, in trading, always begins with discipline. In the philosophy of Richard D. Wyckoff, market confirmation is the cornerstone of all sound trading decisions. It represents the moment when the market itself validates your analysis, when price and volume align to prove that your interpretation of supply and demand was correct. Wyckoff taught that no matter how skilled or experienced a trader may be, opinions are worthless until the market confirms them. Acting before confirmation is speculation in its most dangerous form. Acting after confirmation is operation, the professional's craft. At its essence, market confirmation means allowing the market to reveal its true intention before committing capital. It is the disciplined pause between observation and execution. Wyckoff observed that most traders fail not because their analysis is wrong, but because their timing is premature. They anticipate rather than wait. The professional operator, however, never forces his will upon the market. He listens. He studies the tape, the volume, the structure, and only when price behavior confirms the presence of demand or supply does he act. To understand this, consider Wyckoff's classic example of an accumulation phase. After a period of decline, smart money begins to absorb supply quietly. Price stops falling, volume contracts, and a trading range forms. The public sees stagnation. The operator sees preparation. Yet even here, Wyckoff would not advocate an immediate entry. He would wait for a sign of strength, SOS, a decisive upward movement on expanding volume, followed by a successful test on lower volume. This test is the market's confirmation that supply has been exhausted and demand is in control. Only then does the professional enter, in harmony with the emerging trend. This process illustrates Wyckoff's timeless law of cause and effect. The cause is the accumulation or distribution phase, the quiet groundwork laid by informed interests. The effect is the subsequent trend that follows. But between cause and effect lies confirmation, the bridge that transforms potential into probability. Without waiting for confirmation, a trader risks buying during the cause rather than the beginning of the effect. A costly mistake repeated by 90% of participants who trade from anticipation instead of evidence. Market confirmation also protects the trader from emotional interference. When you let the market validate your plan, you remove ego from the equation. You are no longer attached to being right. You are simply following the logic of price and volume. This detachment is the hallmark of professionalism. It transforms trading from guesswork into a systematic process. Wyckoff's entire method was built on this principle. Observe, interpret, confirm, and then act. He warned against confusing activity with opportunity, reminding his students that the market is always speaking, but only the patient trader hears the truth. Market confirmation is that truth. In summary, market confirmation is not just a signal, it is a philosophy. It teaches patience, respect for market structure, and humility before the collective intelligence of price action. Those who master it trade with the flow of smart money. Those who ignore it fight against it. And as Wyckoff proved time and again, the market never rewards those who fight its laws. The Wyckoff method is more than a trading system. It is a complete philosophy for understanding the inner workings of the market. Developed by Richard D. Wyckoff in the early 20th century. This method remains one of the most profound frameworks for interpreting price and volume behavior. Wyckoff was not content to trade blindly or follow tips. He sought to uncover how and why prices move. He believed the market was a living organism, governed by natural laws of supply and demand, cause and effect, and effort versus result. His method provides traders with the tools to read these laws in action and to align themselves with the footprints of professional money, what he called the composite operator. At its core, the Wyckoff method rests on a simple but powerful truth. Price movement is the direct result of the imbalance between supply and demand. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. Wyckoff's genius was in teaching traders how to interpret this balance through the language of price and volume. He identified recurring patterns in how professional interests accumulate, mark up, distribute, and mark down securities, a four-phase cycle that repeats across all markets and timeframes. 1. Accumulation phase. This is where professionals quietly absorb supply after a decline. Prices appear to move sideways, but underneath, strong hands are buying from weak ones. 2. Markup phase. Once accumulation is complete, prices begin to rise as demand overtakes supply, often leaving the public behind. 3. Distribution phase. Professionals begin to sell their holdings to the public at high prices. Volume expands, but progress stalls, a subtle warning of weakness. 4. Markdown phase. As distribution ends, supply overwhelms demand, and prices fall, completing the cycle. What makes the Wyckoff method extraordinary is its blend of technical precision and psychological insight. Wyckoff understood that markets are human behavior in motion, driven by fear, greed, hope, and uncertainty. His method trains traders to see beyond the chart, to interpret what the smart money is doing behind every bar and volume spike. It's a form of market X-ray vision. Central to Wyckoff's teachings is the composite operator concept. This is the idea that all major price moves are the result of large, informed interests, acting together as if they were one entity. By studying the actions of this operator through accumulation and distribution, traders can align their positions with institutional intent rather than fighting against it. Another critical element of the method is the three laws of Wyckoff. The law of supply and demand: price rises when demand exceeds supply, and vice versa. The law of cause and effect: the size of the base cause determines the magnitude of the move, effect. The law of effort versus result: volume, effort, must be in harmony with price, result. Discrepancies warn of reversals. In essence, the Wyckoff method transforms trading from speculation into structured analysis. It teaches traders to think like professionals, to act on confirmation rather than emotion, and to align with the rhythm of the market itself. It is not merely a method for chart reading, it is a philosophy of market harmony, where success comes not from predicting, but from understanding. In the art of trading, emotional control is the invisible boundary between success and ruin. Richard D. Wyckoff, through decades of studying market operators and the psychology of crowds, recognized that the average trader's greatest adversary is not the market itself, it is his own emotional instability. Prices rise and fall, volume expands and contracts, but what truly dictates the outcome of a trade is how the trader responds to those changes. Emotional control is the discipline to remain calm when the crowd panics, patient when the market is silent, and confident when opportunity appears disguised as uncertainty. Wyckoff taught that every market movement is a reflection of collective emotion, fear, and greed oscillating like tides. When prices fall sharply, fear dominates and forces the public to sell at precisely the wrong moment. When prices soar, greed takes over and they rush to buy at the top. This behavioral cycle repeats endlessly, and those who fail to master their emotions are trapped within it. The professional operator, however, stands apart. He observes the same chaos, but instead of reacting impulsively, he interprets it as information, a signal revealing where the weak hands are surrendering to their emotions. To understand emotional control in trading, one must recognize that it begins long before entering a trade. It starts with preparation, having a clear plan, a defined risk, and an understanding of one's method. Wyckoff emphasized that uncertainty is not an enemy. It is a constant. What destroys most traders is their reaction to uncertainty. When a position moves against them, they interpret it as personal failure rather than natural fluctuation. They abandon their plan, move stop losses, or double down in desperation. The lack of emotional control transforms a small error into a catastrophic loss. In contrast, the emotionally controlled trader treats trading as a business of probabilities, not certainties. He knows that losses are not punishment, but the cost of doing business. Every decision is guided by structure, not impulse. When he's wrong, he exits swiftly and unemotionally. When he's right, he rides the trend with discipline. Wyckoff often described the successful trader as one who could observe without emotional distortion. This ability to see the market objectively as a field of supply and demand, rather than a battlefield of feelings, is the defining trait of the professional. One of Wyckoff's timeless lessons was that the market is designed to deceive the emotional majority. It thrives on shaking out the impatient, the fearful, and the greedy. The only way to escape that trap is to master the internal game. Emotional control allows you to remain aligned with the logic of the market's structure instead of being manipulated by its fluctuations. In conclusion, emotional control is not about suppressing feelings. It is about transcending them through discipline and awareness. A trader who has control over his emotions possesses an advantage greater than any strategy or signal. As Wyckoff said, the market is human nature on display. To conquer it, you must first conquer yourself. Trading consistency is the ultimate goal of every market participant, yet it remains the most elusive. Richard D. Wyckoff understood that while anyone can have a winning trade, only a disciplined, structured operator can win repeatedly over time. Consistency is not the result of luck or prediction, it is the outcome of preparation, discipline, and alignment with the natural laws of the market. In Wyckoff's philosophy, consistency arises when one's methods, mindset, and market understanding are harmonized into a single system of behavior that resists emotional chaos. To Wyckoff, the secret of trading consistency began with methodical thinking. The trader must have a clearly defined process for reading market behavior, an understanding of cause and effect, effort versus result, and the supply-demand dynamics that shape price movement. This process acts as a compass, keeping him grounded even when the market becomes turbulent. Most traders fail this step. They drift between strategies, chase trends, and act impulsively. But the consistent operator studies structure, identifies phases, and waits for confirmation before acting. He does not predict what the market should do. He waits for the market to prove what it is doing. Consistency, Wyckoff believed, is not born from frequency of trades, but from the quality of decisions. The majority of traders lose because they mistake action for progress. They feel the need to trade constantly, as if motion alone equals success. But consistency requires patience, the ability to do nothing until the market presents a high-probability setup. Wyckoff's students were taught that inactivity is not weakness, it is strength. Just as a lion does not chase every movement in the grass, the professional trader conserves his energy for the opportunity that aligns perfectly with his rules. Another foundation of trading consistency is risk management. Wyckoff viewed losses as inevitable but controllable. He taught that the professional trader plans his exit before his entry, defining risk as part of the operation. Inconsistent traders, on the other hand, allow losses to spiral because they react emotionally, not logically. The consistent trader treats every position as one of many within a larger campaign. He never allows a single trade to define his success. This mechanical control over risk ensures survival, and survival, Wyckoff said, is the first condition for profit. Emotional equilibrium also plays a central role. Consistency cannot exist where emotion dominates. The professional trader acts from logic, not hope, from structure, not fear. Wyckoff observed that traders who lack self-control are doomed to cycles of euphoria and despair, winning big, losing bigger, and learning nothing. True consistency requires the ability to remain psychologically neutral, regardless of recent outcomes. A winning streak does not breed overconfidence. A losing streak does not breed fear. In conclusion, trading consistency is not a gift, it is a product of mastery. It is built trade by trade, decision by decision, through unwavering adherence to principles. Wyckoff's timeless wisdom teaches that the market rewards persistence, patience, and precision, not passion. The consistent trader is not the one who wins every time, but the one who follows his plan every time. That, Wyckoff believed, is the essence of professional operation and the only true path to enduring success in the markets. As we bring this exploration to a close, let us remember the timeless wisdom Richard D. Wyckoff left behind, wisdom born not from theory, but from decades of observing human behavior reflected through price. The market, he taught, is not merely a collection of numbers and charts, it is a mirror, revealing the discipline, patience, and emotional maturity of every trader who enters it. The path to trading consistency is not paved with shortcuts or predictions. It is built through mastery of the self. The Hazone rule Wyckoff followed was simple yet profound. Act only when the market confirms your judgment. This single principle filters out the noise of hope and fear, replacing it with structure and logic. It demands discipline to wait, emotional control to stay detached, and faith in process over impulse. Those who ignore this rule fall into the 90%, the crowd, ruled by reaction and emotion. Those who obey it rise to the level of the operator, calm, prepared, and consistent. Wyckoff's method reminds us that the market rewards not those who seek excitement, but those who seek understanding. Each phase of price action, each wave of volume, each test of supply and demand, all are expressions of natural law. To trade successfully, we must learn to move in harmony with those laws, not against them. The true professional does not chase profits. He pursues perfection of execution. He studies, plans, waits, and acts when the evidence is undeniable. Over time, this quiet consistency compounds into mastery. As Wyckoff wrote, "The market does not beat you, you beat yourself." So, if there is one truth to carry forward, it is this. The secret to lasting success in trading is not found in predicting the next move, but in mastering your own. Because in the grand theater of speculation, the strongest signal you will ever receive is the one that comes from your own discipline.